Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So I have a question for you guys. When does the stock market bottom and when does real estate also bottom? Now you might be wondering, what are you talking about? The stock market just bottomed last year, October. You not remember this, Daniel? I understand that completely. Yes, NASDAQ, S&P 500, all ripped out higher from October lows. And you were looking at the price action, you could argue, hey, that's the bottom. In retrospect, it's very easy to say that. However, if you're into macroeconomics like me, you would argue that's not the bottom. You'd argue that, hey, we could see a retest of October lows or get close to that, or we might plunge through that. And all depends, again, on the macro landscape of things. Now, when you look at the macro landscape of things, it's not looking so rosy. You look at the GDI, gross domestic income. It's already in recessionary environment. GDI and GDP, they tend to be very correlated with each other. GDP has yet to show that recession indicator, which is 2 quarters of negative GDP numbers. GDI has already shown 2 negative quarters of GDI numbers, which again says recession. We have yet to see GDP do the same thing, which it will. And again, like I said, they're very correlated with each other. That's one point. The second point is look at the ISM. You look at the manufacturing data, weakness there. You've seen the number go below 50, basically contractionary levels. Although, yes, the economy has been resilient, because if you look at the jobs component, you'll say, oh, look, people still have jobs, so market is still strong. I don't know what you're talking about. The bottom just happened again last year. Just look at the price action. Well, again, going back to those macro numbers again, right? It just doesn't mean just because the macro numbers are showing weakness and the stock market is doing something else, it doesn't necessarily mean that's the bottom, right? There's a lot of sentiment that goes into the market pricing. There's a lot of speculation that goes into the market pricing, right? And if everybody thinks that's the bottom in history, when you tend to see things when a crowd is on one side of the trade, they tend to be wrong, right? Just like in October of last year, everyone was super bearish. What happened? Massive squeeze, and then you saw a nice rally in NASDAQ and in S&P 500, which was driven by the top 7 high-flying big tech companies that were driving the index higher because everyone was so damn bearish. Now, if everyone is saying that, okay, recession's been curved, if the sentiment has moved towards that, everyone's starting to turn bullish, we got to chase this, etc., buy the dip, and everyone started to move there and saying, hey, October lows was the low, then again, that poses that scenario where a lot of traders could be caught off guard, which then causes the sell-off or the panic selling. But it's not as simple as it sounds like I just explained there. Again, there's got to be something that catches people off guard, that surprises people, like AKA bond yields, AKA the Federal Reserve. The bond market is listening, and the stock market started to listen as well to the Federal Reserve saying, oh shit, Jerome Powell may keep rates actually higher for longer, even though he's been saying that for a very long time. But he may keep rates higher for longer, which could cause bond yields to continue to move up higher. And if he hikes rates further, that will probably cause strain for a lot of people in the market who have mortgages, maybe the shadow banking sector, commercial banks. A lot of people who have loans and debt that are coming due next year. Maybe these mortgages who need to be refinanced. The commercial banks, the commercial real estate as well. That may affect the banking sector. Again, there's risks there on the macro side of things. So there are many things that could catch the equity market off guard, and there's things from the bond market that could trigger the stock market to basically sell off on fears that, oh my gosh, the rates are going higher, should not own any risky assets, or maybe some sort of credit event that causes the sell-off. Now, you could speculate many things, right? And that's not the point of the video. Don't want to speculate into what it is that's going to be creating the event, but there are risks there, I would say, from a macro side of things. Now, if we go back and look at history as well, going back to the question I first asked, when does the stock market bottom? And when you look at history and take 2008 as an example, the great financial crisis, it tends to bottom a year after rate cuts, from the first rate cut. So take a year from the first rate cut, which if you go back during the great financial crisis era, the first rate cut started to happen around 2000. And if you take a year of that, and then you had the real plunge happen in September of 2008, take a year of that, you see, okay, by the end of 2008, 2009, around there, that's when the stock market basically kind of bottomed there. So a year later, after all these rate cuts that were happening, and again, taking a year later from the first rate cut. So could we see the same thing here? Now we don't have rate cuts. So if we take this principle and we say, okay, let's just say we use this rule that, that some people may be following, that, okay, a year after the rate cuts, that means that so far we haven't seen any rate cuts, so that means there's no bottom yet. So the bottom may happen from when we start to see rate cuts. Maybe that is, let's just hypothetically say, to 2024, next year, we start to get rate cuts. Let's just say hypothetically it happens mid of next year, maybe third quarter of next year, or maybe the end of next year, fourth quarter, right? Take that, span it out to a year, that means 2025 is when maybe we might see the bottom in the equity markets, because we haven't got rate cuts yet, and we're not going to get rate cuts until there is strong damage in the markets. And if you look at the Federal Reserve, a lot of people out there, again, realtors and so on, they say that, oh, rate cuts are coming. No, when you look at history, the Federal Reserve doesn't come in to cut rates until there's been clear damage in the economy, and most importantly also the equity market. When you get a panic in the equity markets, meaning the stock market, that's when you get intervention from the Federal Reserve. And if you look at past history in recessions and crashes, that's when you get the Federal Reserve intervene. And they haven't. And last year is not a crash. That's an orderly sell-off. So we haven't seen a crash yet, which again goes back to what I was saying is, I wouldn't say that October last year was the bottom. We could retest it, we could come close to it, or we could break through it, but we still have risks down the road. We haven't even got to rate cuts yet. And rate cuts happen when there is panic in the economy, in the stock market, something is breaking. So we're not just going to get magically rate cuts just because, oh, don't worry, I heard from, let's say Remax that rate cuts are coming next year. No, I mean, unless Remax believes that there's going to be a disastrous credit event next year and they've got information on that, then okay, that's a different story. But I don't think they do. Oh, maybe they do because they deal with real estate, right? So they might be seeing what's happening in the office space or commercial real estate. Maybe they say, oh, shoot, something's wrong there. But if I were gun to my head, I would think that, they probably don't have access to that information. Maybe they do a little bit, but in terms of globally, maybe they are unable to see what's coming. And I think it's very difficult to actually predict that. So, bottom tends to happen from the first rate cut in the stock market. And for the real estate market, real estate is more lagging in nature because it's not a leading asset. The stock market is a leading asset. It's very liquid, and of course liquidity can dry up in the stock market, panic can happen and so on that causes these ugly sell-offs. However, it's very different, the stock market, from the real estate market because you're comparing the public market versus the private market. In the public markets, just look at REITs on the stock exchange. They've been pricing in the crash, the fears, the higher rates in the prices of REITs. The prices of REITs have dropped. A lot of the real estate stocks have dropped 30%. Yet real estate assets, private markets, have yet to be marked properly, and they tend to lag. So in general, in history, it could take about, if it takes 1 year for the markets to bottom from the first rate cut, it could take 2 to maybe 3 years for real estate to really bottom out and then move up. Because again, the lag component. And you can look at this in the last crisis, the great financial crisis, it took about 2 to 3 years for real estate to then pick back up, right? So all the FOMO that you're hearing, that buy real estate, you're going to regret it when the rate cuts happen, relax, right? First of all, don't FOMO into any investment out there, whether it's stocks or real estate. Second of all, assess the information. Of course, I totally get it. You got to pull the trigger eventually, right? But don't FOMO in. Don't let FOMO affect you into your decision making. Never have that be a factor in causing you to buy. There will be time, especially if there's a hard landing, hard crash, hard recession, there will be time, right? So don't let anyone force you into something. Do your analysis, do your due diligence, become prepared. If such and such happens, what will you do, right? And if it's out of your budget, out of your price, you're obviously don't chase. Don't chase a asset, don't chase an investment. There will be a lot of opportunities down the road, okay? Just because you miss out on, let's say, one house, one investment, there are a lot of opportunities out there, a lot of investments out there. And especially when you look at history and when you look at past recessions, and especially if this is going to look maybe similar to 2008, or if let me say this, if it's going to be a hard landing, a hard recession, it's going to take people some time to recover. All right. So this whole mentality of chase, rate cuts come and you're going to miss out, it doesn't make sense. If the economy is going to hit, go through a very turbulent time and people are going to lose their jobs, nobody's going to be chasing anything. They're going to be chasing jobs actually to get some sort of, selling their investments to get some sort of cash savings so they can pay their bills and not go under, right? That's what's coming. Not the FOMO that, the internet may put out there or other sales agents may put out there. Anyways, my 2 cents, I'm not an financial registered investment advisor, right? So don't take any advice from me. Always consult with a registered investment financial advisor. I'm only taking data, taking macro, taking histories of price action and how data has played out in the past, and putting it all together and speculating, saying that how the economy may look like with the current data and information that I have. I could be right, I could be wrong, just like anyone else, right? But always do your own due diligence with a clear head and make your own decision on what you think is right. And if you don't know, get someone who is registered, registered investment advisor to help you with that process. It doesn't hurt to get some help. Anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.